My name is Michael Guyett, publisher of the Lead Lag Report. Our special guest, Brent Johnson. Brent, by the way, I was in Puerto Rico 4 weeks ago. I'm a little jealous of your situation, which we'll talk about a little bit towards the end. All right, so Brent, I know we went through this the last time we did a space, but just to set the stage for everybody here, talk about your background, who you are, and how you came up with the Dollar Milkshake Theory, and then we'll get into a lot of the stuff that's going on real time.
Sure. So I'll try to make this relatively quick, but I was in traditional finance for a number of years. I worked at Donaldson, Lufkin, and Jenrette in both Credit Suisse for almost 11 years in their high net worth group, where I was managing money for high net worth individuals. And really, kind of in the middle of the global financial crisis, I kind of had a awakening, for lack of a better word, where I realized that being part of a big firm was really, really hard to do the right thing for your clients. At least from my perspective, it was. And so, coming out of the global financial crisis, I joined an independent firm that a friend of mine had set up. So I moved my clients over there. That was called Baker Avenue Asset Management. They manage a couple billion for, again, individuals. Along the way, I set up Santiago Capital, which was doing some precious metals investing, some alternative investments. I was advising a few friends on, some other things. So it was kind of a side business originally. But then it kind of got to be a size where, it got a little confusing. Is Brent Santiago, or is he part of Baker Avenue? And, for a lot of reasons, I ended up just moving all of my business under Santiago Capital. And so Santiago Capital is an SEC registered and an NFA registered investment advisory firm. We manage about $175 million for a handful of clients through separately managed accounts and a few private funds. So my the awakening that I mentioned in 2008 really led me to not just accept what I was told, and it really led me to kind of dig into how the monetary system is designed and how it actually works and how money flows around the world and all the different, inputs and the things that influence it. I probably was told this at one point along the way in college, and I probably just learned it long enough to memorize it. But this time I actually went back and really made an effort to understand it. And the interesting thing about the whole dollar milkshake theory is it really came about as a result of me being such a big believer in gold. And that may sound a little ironic or a little counterintuitive, because most people in the gold world, are not fans of the dollar. They think the dollar is a horrible currency and that it's going to zero. And I actually don't agree with them, or don't disagree with them too much on that. It's just that I have found that through my study and through my analysis that every other currency is even worse. And as a result of a number of the advantages that the U.S. has, and the global reserve currency gives one, that it's going to be the last man standing. I think we're in this global super debt cycle, for the end of this super debt cycle, and I think we're going to get into a period where debt matters. It has not mattered. So I've been saying for probably 3 or 4 years now that we're going to have a global sovereign debt and currency crisis. And on Wall Street, if you get the timing wrong, well, then you're wrong. So I'm the first one to hold up my hands and say, I got it wrong. It hasn't mattered. Debt has not mattered. So I've been wrong for the last, call it 2 or 3 years, 4 years. But I don't think I'm going to be wrong for the next 2 or 3, 4 years. I think we are going to have this sovereign debt crisis. I think we are going to have this currency crisis. And I think when that happens, the dollar is going to get much stronger. I think the U.S. dollar, U.S. assets are going to soak up all the global liquidity that gets printed. And that's where the milkshake comes from, is I think the dollar is going to drink the milkshake that the rest of the world produces. So that's a very long, rambling way of answering your question, but I hope that makes sense.
No, that's good. And on that point about, debt hasn't mattered. You and I both know there's this great saying, nothing matters until it matters. And then when it matters, it's the only thing that matters. And of course, there's always a fine line between being early and wrong. I always go back to this point that a lot of people were wrong in arguing that housing would cause a great financial crisis in 05, 06. They were wrong all the way up until obviously the Lehman crash. Right. So it's always about perspective. Now, honest to God, Brent, I'm not lying when I say this. So I've been so overwhelmingly busy, and I didn't go through your most recent tweets, but I saw one of your tweets happens to be exactly along the same lines that I'm thinking around what's happening with Japan and the yen. And I put out that tweet literally just before I seen that you were putting out some content around that Japan is the black swan. And if you're not paying attention to the yen, you have no fucking clue what's really happening here as far as butterfly effects. I want you to talk through how you're seeing this yen crash. What are the implications? We know it's partially because of the yield curve control, but I want to hear you riff a little bit around what's happening with the yen, because I think that may end up being the real story this year.
Yeah, so happy to talk about that, and I agree with you. I think, in my opinion, and it's starting to get more traction, but in my opinion, the kind of the breakdown in the yen is the most important story that people aren't focused on. I'm not going to say nobody's looking at it because there are people looking at it, but it hasn't garnered the headlines as much as the U.S. 10-year yield, as an example. And so I'll start there. Everybody knows that the U.S. 10-year yield has been rising. It's to offset the inflationary pressures that the U.S. has been feeling since the Fed's mandates and the supply chain issues and the stimmies and all that kind of stuff. But and it's got a lot of attention, and as it should. But the point I always like to make is this is not a uniquely American situation. Yields are rising around the world. They're rising in Europe. They're rising in South America. They're rising in China. They're rising kind of all over the place. And they're even rising, if you can believe it or not, in Japan, where they've had deflation for decades and decades. And so, it's risen to a level where the Bank of Japan is having to make a decision. Are we going to save the bond market? In other words, are we going to continue buying bonds in order to keep yields low? But if we do that, then the currency falls in value, right? And so, but they can't do both. They've got to choose. And so far, they have chosen to maintain the bond market because, again, it takes a little history to understand this, but yields have been so low in Japan forever, and Japanese investors have bought tons of these, and then the central bank has bought a ton of these, JGBs, and they bought them with 0 to negative yields. So if yields rise even a little bit, it wipes out pension funds and institutions and endowments, and you could even argue it wipes out the central bank's balance sheet. And so yields kind of have to stay low. And again, this is not just a U.S. problem, but the problem is in doing that they're just killing the yen. Well, the yen, has been on this support line, this 40-year support line, where it's touched it several times and bounced it, but it finally broke through it. And if you're a technical analyst, there's not much resistance from here. And like those, the butterfly that flaps its wings in one part of the world and that causes a tsunami in the other part. This has big knock-on effects in the world of macro, and where I think people aren't quite understanding is this is going to have knock-on effects for China, because China is a competing regional currency, it's a competing economy, and the last two times that, or last three times, or last two times that the yen has weakened significantly, it eventually led to the yuan weakening as well. Now, if you look at it on a chart, it's not real, dramatic, but it's because the yuan is a managed currency. It was pegged, and it still is kind of quasi-pegged. So, the PBOC kind of keeps that in check. If it was allowed to float, I think these moves would be a lot more dramatic. And this move in the yen is more dramatic than the other two. And so now you're starting to see the yuan weaken. And the yuan weakening, that's a big deal too. And that has big implications for the rest of the world. If the yuan were to weaken dramatically, or if the PBOC were to let it weaken, or if they were to devalue their currency in order to fight the deflationary pressures they're getting from their real estate market, that would basically send a deflationary shockwave to the rest of the world. Now, you can imagine what the dollar would do in that scenario. And we all know if the dollar goes up, it causes all kinds of problems. So, my point is that debt has not mattered for a very long time. But now the amount of debt is starting to matter, especially with interest rates rising. And I think you're going to see a lot of knock-on effects that maybe the central bankers and the monetary authorities think that they control, that perhaps they find out they can't quite control. And so I just think it's really kind of a interesting setup that we have right now. And I think regardless of which way these yields go, I think we get a lot of volatility.
What's the lesser of two evils in that situation for Japan? Let the yen keep cratering, or let yields rise and end yield curve control?
Well, I think it kind of depends on, when you say who, it depends on who you are. If you're the government, you're better off letting the currency go, right?
Right.
If you're a citizen, you'd rather have the bond market go and have your currency maintain some value. But it's a really really tough question, and I don't pretend to know the answer. I just know that they're really in a tough spot. My guess is that I think that they have to save the bond market. So now I do think actually that the yen has kind of broken through that resistance level, and it's very oversold right now. It wouldn't surprise me at all to see kind of a dead cat bounce or a counter trend rally back to that resistance line. But I think the kind of the horse is out of the barn, so to speak, and I don't think that the Bank of Japan can really turn around and save the currency and let the bond market go. Now they might hint at it. They might get enough political pressure says we can't just crush the currency, and they might have to make a few hawkish comments at some point in order to save the currency. But again, I think they're really stuck. I think when the really push really comes to shove, they'll save the currency at the expense of or they'll save the bond market at the extent of the currency. And this is probably a good point, and I'm sorry to ramble on, but this stuff comes to me as I'm thinking, and I want to make sure I get this point across. This has been, I think, talked about a lot more with regard to the dollar than it has these other currencies. How does the U.S. get out of this mess? How do they have to keep rates low? So obviously the dollar is going to fall. And the point that I've always been making, it's not that I disagree with that. The Fed has the same problem too. The U.S. has the same problem too. But the issue is that the US dollar has global demand, and many of these other currencies don't have global demand. So it's much harder for the other countries to deal with this problem than it is for the US to deal with this problem. And it's not that the US won't ever have to do it. I just think that they're going to have to do it last. And you can see that now. This is, Japan is having to make this decision before the US is. We have not gone to yield curve control. At some point, will we have to? Possibly. But you know what? Japan is already there. Europe has still not started raising rates. So the U.S., as bad a situation as it's in, on a relative basis, it looks pretty good.
And all that, presumably, which seems to be playing out, I mean, the dollar keeps on pushing higher, certainly against the euro, but presumably that means at some point you would see the 10-year yield spike stop, right? That you'd see some stabilization in Treasury. So I want you to talk through that dynamic, because that's been one of the most frustrating things for me personally and professionally, in that treasuries have not acted risk off at all. You've had this really historically anomalous juncture where, from a sequence of return perspective, treasuries and stocks sell off one for one, unlike the historical behavior, right, where you get that flight to safety, yields drop as stocks become volatile. I think, by the way, that's maybe starting to transition, as I've been kind of teasing a little bit. But talk through sort of that dynamic, because I think people are assuming it's a foregone conclusion that yields rise, but they're not recognizing not only where on the term structure yields rise, short or long end, and then which yields, treasuries versus credit risk corporate bonds.
Yeah. So I have a lot of friends, because I believe the dollar is going higher. I typically get labeled a deflationist, which I don't really have time to explain it all. That's not technically correct, but I don't mind it, because typically when the dollar goes higher, that is typically deflationary. And as a result, then a lot of people think that I'm a huge treasury bull. The reality is I'm kind of agnostic on treasuries, but you obviously have to watch them, right? My guess is that we will get another rally in bonds before this is all said and done. I think we're kind of up near the top of that 40-year channel. I think we've even poked through it a little bit. My guess is at some point we're going to get a risk off rally, and those treasury yields will come back down, and treasury bonds will rise. What I find more interesting than that, two things. One, to me, it doesn't really matter which way yields to go. Whichever way yields go from here, I think it leads to volatility and risk off. And so let me tell you what I mean. Well, if the yields continue going higher, that just makes the US dollar even more attractive. If you can get paid more to sit in a 10-year treasury than you can in a Chinese treasury, then you're going to sit in a US treasury. I mean, it just makes sense. And over the last 2 years, you've seen the yuan dramatically outperform the dollar. You saw all these capital flows into China, which supported their bond market, which supported their real estate market. But now those flows are reversing, and the reason they're reversing is they're not growing the same level that they were. They're having these deflationary pressures in their real estate market. The yield differential that you got for buying a Chinese treasury over a U.S. treasury is gone. The U.S. treasury, I think, now yields more than a Chinese treasury. And so not only is China no longer getting those inflows. The money's actually starting to flow out of China. So I think if U.S. yields went higher, it just exacerbates that anymore. And money flowing out of China is risk off for global growth. Let's look at the other scenario. If yields drop dramatically, well, then that's obviously a sign of risk off, right? And so, if yields go from, I don't even know where they're at now, 275, 285, something like that. If they turn around and go back, let's just say 225, think about it. I mean, they've doubled in the last year. If it just went back to 225, that's a 25% move in yields. That would be, you would have to assume that there would be some kind of risk off event that would cause treasuries to rally that much. So again, whether yields go higher or whether yields go lower, I really don't know. I don't. My guess is that they go lower, but in either scenario, I think you need to be prepared for volatility.
Yeah, and to that point, that's why I think this is so tricky and for people to get their minds around how this could play out, because you could have yields on treasuries go lower while bonds keep selling off, which is
Yes.
a risk off period, spread wide.
Yeah, and that's the thing is, so far, what's kind of surprising to me is, we're starting to see these pockets of volatility. I mean, equities have had, a tough year so far, but they're still, I mean, even with the tough year that they've had, they're not dramatically lower than they were at the beginning of the year. Some tech stocks are a lot lower, but, it wasn't just a week ago, the Dow was getting pretty close back up to its all-time high again. And so, despite the fact that the dollar has gone higher, despite the fact that yields have jumped, overall volatility hasn't really exploded. Now, it went high in, when on the geopolitical stuff a month ago, and the VIX is at 25 today, but a week ago it was at 20 or 21 or whatever it was. So, that's actually not too high. And I think part of the reason is that despite the rise in government yields around the world, spreads have remained relatively tight. And I think that that's going to break. I think, again, regardless of which way yields go, I think spreads are going to start to widen. And I think when spreads start to widen, that's when you really get volatility. As long as the credit markets hold up, markets tend to hold up. But I think as credit markets start to deteriorate and spreads widen, that's when you're going to start to see, some bodies rise to the surface, so to speak.
That's 100% the way that I think that this probably plays out, because you're right, spreads stayed tight, so you had this whole shift in the bond market. People saw a crash in the bond market thinking that it's like every other big decline in bonds. It's not. Behaviorally, this is not one of those types of sell-offs you've seen. And yes, it's because of inflation, but if you were to have that spread widening event still to come, the bigger risk off period to come, that's going to also slow the Fed down. And I always go back to this point that you always hear this line that the Fed cares about the market, and everyone assumes the market means the stock market. What they really care about is spreads movement, right? So talk through if you think the Fed is getting more and more nervous about the behavior of the dollar, because the dollar has probably been more effective at pushing disinflation than a measly 25 basis points.
Yeah. So there's a couple points I want to make here. One, is the Fed serious about fighting inflation and raising rates? And if they are serious, can they even do it? Right. Well, the first thing I'd say is, just think back a year ago. A year ago, absolutely nobody, and I shouldn't say absolutely no, but very few people thought that the stimulus checks would ever end and that rates would ever be, raised. I mean, it was just a foregone conclusion that they were going to hold rates low, they were going to print money, and they were going to, through financial engineering, inflate away all the debt. Right? It was basically a given. And the point that I always tried to make is that works extremely well on a spreadsheet and in kind of in theory. But it's really, financial repression is really, really hard politically. That financial repression is what leads to revolts, right, and revolutions, because cost of living rises, your income goes down, and the citizenry gets squeezed. So while it works really good on a spreadsheet, it's really, really hard politically to pull off. And that's kind of where we're at today. The inflationary pressures have got to a point where the Fed cannot just keep rates low and keep buying bonds. They've had to start raising rates. Now, I think and then not only that, but the inequality issue exploded. So I think because of the political pressure that they're feeling, I think the Fed is serious about raising rates and trying to tame inflation. Now, and I think that they will raise until they break the market, and then they'll try to save it again. That's one thing I would say. So I think that they're more inclined to raise than a lot of people think they are, but it doesn't mean that they will be successful in it. The other point I would make, and this one is a little bit more, I don't know if controversial is the right way, but perhaps underappreciated, and I think a lot of people would push back on this. But when you consider all the debt in the world, and you consider what we're seeing in the stock market, and you consider the shipping freights are rolling over and coming down, and China's got these COVID lockdowns. Some people would be saying, "Whoa, why is the Fed such in a hurry to raise rates? Why are they saying we're going to raise 5 or 6 times? Why don't they just say we're going to raise once or twice and at 25 basis points?" And they're kind of going out of their way to be hawkish. And I think part of it, everybody says that the Fed is independent and central banks are independent. And I personally believe that's the biggest myth that's ever taught in business school. I do not think central banks are independent. If you think of rate hikes in a geopolitical sense, they make a lot more sense than from a domestic monetary policy sense. And what I mean by that is when Europe raises rates, they raise rates on Europe. When Japan raises rates, they raise rates on Japan. But when the US raises rates, they raise rates on the whole world because the US dollar is the funding currency for the whole world. And right now, you're starting to see, this is kind of the milkshake that I've been talking about. The rest of the world needs dollars, and the cost to get those dollars is rising. Not only the price of the dollar, but the interest rate associated with the dollar is higher. And so you've got this situation where global growth is slowing. Their top line revenue is no longer growing as much, but now their funding costs are going up. They're getting squeezed, and they're going to have to start printing their own currencies to kind of fight these pressures. But it's the worst of both worlds because they're getting inflation in their local currency terms, but they're getting deflationary pressures in their funding currency terms. It's damned if you do and damned if you don't. I mean, they're in a real bind. And that's what I mean with these rate hikes. It almost looks to me like the US is purposefully squeezing the world. And I think the US knows that it's in a bad spot. So if there's going to be trouble, better that it's trouble that you're causing than it coming to you. So now maybe I'm completely wrong on that. But when I think of it in that term, and when I think of the dollar used as a weapon, which we all have seen over the last 6 weeks, the dollar can be used as a weapon. When I think about rate hikes being used as a weapon to squeeze our competitors as opposed to just necessarily, fighting inflation here at home, the hawkishness from the Fed starts to make a lot more sense to me. If you look at kind of retail sales, they're starting to come down. Some other economic indicators are starting to come down. So again, their balance sheets are in great shape because of what went on over the last couple of years, right? But going forward, and so they have this cash on their balance sheet. They got these bonds issued at really low rates. Unless they're variable, unless they reset fairly soon, they're in kind of good shape. But they need to kind of keep. I guess my point is that they're stocked up, but when that stock starts to run low, how are they going to get it again, right? Unless the economy keeps humming, and if the economy starts to turn down, even though their balance sheets are in good shape right now, they might not be in 6 months or a year.
You can't really talk about debt, Brent, unless you talk about housing, right? And I've been pounding the table on this since maybe about a month and a half, 2 months ago, that using dramatic terminology, your home is about to be worth less, and people seem to think I'm saying worthless, which is not obviously the case. But I want to hear you talk about your view on debt and how the housing market has played out here, because I've talked to a lot of different people from different countries, and when I ask them, how is housing in your localities, they all say the same thing. And it sounds like exactly what I could say as somebody being in New York. This housing boom is a global phenomenon, which makes sense, right? So let's talk about leverage debt and how you think that plays out when it comes to what most people care about, which is the value of their home.
Well, I think in general, I think this is pretty well accepted at this point that over the last, call it 10 or 15 years, people have been able to buy much more house than they typically would have been because interest rates have been extremely low. And, the carry on the mortgage has been pretty low. And with the asset prices rising, they just keep, selling one property, levering up into another one, selling that one, levering up into another one. And, it's led to prices going higher. And it's led to, in many cases, actually, I'd say in most cases, somebody's home or their mortgage is both their biggest asset and their biggest liability. And so as you said, it's hard to talk about debt without talking about housing. And not only that, but the cost of a mortgage. Like we're thinking about buying an apartment here in Puerto Rico, and the mortgage rate's going to be double what it was a year ago, or 40% higher than it was a year ago. And so that, again, if you locked in a 30-year a year or two ago, it doesn't necessarily affect you from a carry standpoint. But if that now higher rate keeps new people from buying because now they can't afford as much home as they used to be able to do because the rate is now twice as high, maybe the value of the home you bought a year ago going rate, right? And we all know what happened in 2008 when not only did prices have to go down, they just had to stop going up for big problems to happen. Now, I will also, so I think it's an issue here in the US. That said, I think it is less of an issue here, again, because I think we will be somewhat shielded. I shouldn't say somewhat shielded. On a relative basis, I think we will hold up better than the rest of the world when this debt crisis hits. That doesn't mean that we're shielded. It just means on a relative basis we're better. But where I think housing is going to be a much bigger deal and much more important is in Canada and Australia. If you were to look at like the debt to income and all these other figures for Australia and Canada with regard to their real estate market, and you were to compare them to those same ratios that the US had in 2008 prior to the financial crisis, you would say that the US in 2008 was a bastion of fiscal austerity. I mean, the numbers in Australia and Canada are they're crazy. And not only that, a lot of people don't know is that in Canada and Australia, they do not have 30-year mortgages. They're typically, or they might have a 30-year mortgage, but they reset every 5 years. So, even if you have a 30-year mortgage, the rate will reset. Now, think about how many houses were bought over the last 3 or 4 or 5 years, right? And now those rates are going to start resetting this year, next year, the year after that. And with rates going where they're at, that's going to be a big problem. Not only that, we go back to what I was talking about China earlier. Again, I think China's in more trouble than a lot of the rest of the world thinks that they are. And I think when China's economy slows, they will not be buying as much from places like Canada and Australia as they are now. And so I think those economies could really get hurt from slowing global growth and rising rates, perhaps even more so than the United States.
And I think that's what makes it difficult for people to really assess asset allocation and timing now, because it's clear there are these landmines out there that you could wake up overnight and suddenly the stock market cares about what's going on with property prices in China, cares about a deceleration in housing in Australia, Canada, and domestically in its borders. So how do you think through how to position in an environment where these 1 in 1,000 year events may happen more consecutively, right? Because I really do. I mean, and I always go back to the point, like every tail risk is ultimately because there's too much leverage prior to the tail actually manifesting and showing that low probability, high outcome event.
I'll tell you in general, when I manage money for clients, there are no two clients that have the same portfolio. I customize everything to them personally because everybody's situation is different. Everybody's asset mix is different. Some people run companies, some have a big stock position. Some people inherited an individual stock from their uncle who started a company, whatever it is. So I always kind of tailor it to what they have specifically. But what I do with everybody, just as a roadmap, is I show them this concept. You've probably heard it before. There's various versions of it, of the permanent portfolio. And my version of the permanent portfolio is 25% cash or fixed income, 25% equities, 25% real estate, and 25% gold or precious metals. Now, if you had that portfolio and you just rebalanced it at 25% every year for the last 50 years, you would have almost kept up with the S&P 500, and you only would have lost money 4 times, and the most you ever would have lost was 12%. So now, nobody's actually going to do that portfolio. But my point is if you did just do that and did nothing else, you're going to be fine, and you're going to get through anything. And so I'm somebody who definitely believes in diversification, and then try to optimize around that diversification. When you see interest rates at 5,000-year lows, maybe you underweight bonds a little bit, right? When you see gold at 20-year lows, maybe you overweight gold a little bit, or whatever it is. But my point is I kind of use that as a roadmap. But then what I also do is I do kind of tweak it. So right now, I do not have any exposure to EM, or if I have exposure to EM, it's very, very minimal. And the reason is because I cannot foresee a scenario where the rest of the world does well and the US does not. But I can envision a scenario where, on a relative basis, the U.S. does well and the rest of the world does not. So I have four different scenarios. One, the whole world can rise together, and some new technology is discovered, and we get global growth, and everything's fine, and we just kind of grow our way out of this problem. Now, I think that's a fairly low probability, but that's one probability. In that case, I'm just as good being in the U.S., or I'm not, or I'm going to be okay being in the U.S. The second scenario is that the whole world goes down together. And if the whole world goes down together, then you're no worse being in the U.S. than you are being in EM. So you might as well just be in the U.S. Okay. The other scenario is that the U.S. does okay and the rest of the world does really bad. We've seen that many times. Anytime there's ever been an EM crisis, that's what an EM crisis is. Money leaves the emerging markets and comes to the United States, safe haven. So that I think is a fairly high probability. The other last probability is that the U.S. goes into this severe recession, has this big calamity, and the rest of the world is sunshine and roses. Now, I think that last probability is so low that I don't even need to worry about it. But in all those other three scenarios, I'm just as well being in the U.S. as I am being overseas. And so from that, and again, this isn't to say the U.S. is the greatest place in the world and we have everything figured out and we don't have problems. I just mean on a relative basis over the next 3 or 4 years, I prefer to be in U.S. markets. I don't see a downside to being in U.S. markets versus being in EM. And so that's what I mean by I keep diversification. Asset allocation is important, but I do try to tweak it on certain themes that I see. And then on top of all of that, asset allocation, we do a number of these kind of one-off asymmetric trades, kind of black swan tail risk type trades. Now, I'll tell you, I've been doing that for a number of years, and those black swan tail risk trades have not paid off. In fact, they've done really poorly because the world has not blown up. Debt hasn't mattered. But I believe in having an insurance policy, and I kind of view those trades as an insurance policy against your portfolio. So we allocate, between 3 and 5% of somebody's overall portfolio to these trades. If these trades pay off, the 3 to 5% could literally become 20, 30% of the portfolio. If they don't, you lose your 2 or 3, 4, 5%. But that means the other 95% of your portfolio is rocking and rolling and more than made up for the 3 to 5% that you lost. So that's how I do it. Some people agree with it, some people don't, but that's kind of how I'm looking at it and how I'm planning to get through the next 3 to 5 years.
I always use this line that your ability to stick to a strategy matters more than the strategy itself. Right? That's why right? The joke about buy and hold is nobody holds, right? That's why it's a fantasy when you think about it. Now, it's interesting you mentioned the permanent portfolio idea, and you can relate it to its cousin, which is risk parity. And I deal with a lot of advisors, and I've had a few advisors ask my opinion on why is it that some of these risk parity permanent portfolio funds have done so quote unquote poorly.
Yeah.
And largely because of treasuries, right? It goes back to that as the right. Real diversifier hasn't worked. So, of course, if you have any kind of blend with treasuries, it's not going to do well. But and I talked through that, but I have to tell you, it's remarkable to me how short-term people get, even when it comes to diversification in periods like this, because diversification doesn't mean you're not going to lose. It means that you are cutting off your own tails of the overall portfolio, right? Now, when you're dealing with separately managed accounts, as you are, right, it's a lot easier to handhold and talk people through that. It's very hard for people to think beyond the here and now and realize that diversification still means you have losses.
Yeah. Well, and I think the other thing too that people get caught up in is, I'm just going to use this as an example, and I know I'm going to get hate for this because every time I've brought this topic up for the last 3 or 4 years, I always get hate for it. But let's talk uranium stocks, right? The story has not changed on uranium for 10 years. And for the last 8 years, it hasn't worked. But then the last 2, it started to work really, really well, right? And so, but I mean, that was 8 years of just nothing where it didn't work, but people still held on to it. And every year was the year it was going to happen. And I guess my point is, why is it okay to hold on to gold or gold miners or uranium or something like this that, it might take 5, 10, 15 years to really play out. But yet, as soon as bonds go down for 6 months, you got to sell out of them and never buy them again. Do you know what I mean? Like, and so, and it, clearly uranium and, the gold miners, they have much higher kind of growth potential than a bond does. But the theory is kind of still the same. And I think it just kind of goes to people's, it's very tough for people to kind of stick to a long-term plan, especially if the long-term plan starts to go against them a little bit. It's the whole cocktail party thing, right? You're at a cocktail party and your friend's making a ton of money and you're not. You're kind of pissed off, and I want to make money too. And so I think there's a lot of that goes on as well. But I think overall, to your point, like discipline in investing is probably the most important thing. And it's really kind of hard when a portion of your portfolio is kind of consistently going against you. It's kind of hard to stay with it sometimes. But if I think when a portion of your portfolio is really going against you, that's when you got to step back and you got to look at the portfolio rather than just the position. Because anything can happen with a position, especially in today's day with headline driven markets. One false headline can come out and make a position totally go against you, and then 48 hours that headline's refuted and everything's back to normal. So I know it's difficult to do, but I think it's really important to kind of come up with a long-term plan and then kind of stick to it. And then the last thing I would say on that is whenever I get a new client, there's two things I always tell. I said every time we meet, there should be two questions you ask me. I said the first question you should ask me is, where are we making money? And if we're not making money anywhere, that's a problem, right? But the second question you should ask me is, where are we losing money? And this is going to sound weird, but if we're not losing money somewhere, that's a problem too. Because if we're not losing money somewhere in the portfolio, then we're not diversified. And when that black swan comes out of nowhere, that rogue wave that we're not ready for, everything's going to go down together too. So again, some of my clients don't really like that. They're like, I want to make money in every part of my portfolio. And I'm like, I get it. I want to too. But I just know from experience that doesn't tend to actually work out very well over the long term. And so it's really kind of an education process as much as anything.
I love that because that's a variation of the line I keep using, which is that if you don't have a portion of your portfolio that you hate, you are not diversified.
That's perfect. That's a perfect way of saying it. One point of clarification. I think it's very possible that the U.S. underperforms emerging markets. What I don't think is possible is for the U.S. to go into a really bad recession and EM not to go with us. So if everything's okay and everything's growing, then the U.S. could definitely underperform. But in some kind of a global risk-off event, I don't think it's possible for the U.S. to go down and emerging markets to go up. So what would cause me to reassess that? Well, if in some kind of a global crisis, if commodity prices stayed high, which maybe they will due to all these supply chain issues, and those countries were able to continue to sell their products at a level that allowed them to service their debt and kind of do that kind of continually for, I don't know, a number of quarters or a year without blowing up in the process, then maybe I have to reassess that. Again, I don't think that that's very likely. I can't completely rule it out, but I guess if that were to start to happen, I would just have to pivot at that point. But part of the reason I think it's a pretty low probability is I can't imagine too many scenarios where that happens. I try to come up with them, and it's kind of just pure speculation on my part. Mm-hmm. Well, it's always challenging, and part of the issue, and if any of my clients are listening to this, I apologize if this offends you in any way, but a lot of my clients are extremely intelligent and extremely successful. That's why they are in the position they're in, and that's why they have enough capital that needs some attention. But they're not necessarily versed in sophisticated financial terminology or education or whatever it is, right? And partly that's why they've come to me. Most of my clients don't want to manage their own portfolio. It's not that they couldn't; it's just that they don't want to, and then so they've hired me to kind of take that off their shoulders. But to your point, probably the biggest part of my job is kind of education and kind of coming up with I'm very much a big picture guy. So I don't get involved and bogged down into individual stocks. I try to lay out the strategy. I kind of come up with the big picture. And then I always try to have as much data as possible to kind of back it up, right? So I think the more data you have, the more easy it makes it. And then the other thing is, I think most people who know me would agree that I'm not a yes man, even with my clients. Like if my clients ask me something and I disagree with it, I'll be polite and I'll, hash it out with them. But at the end of the day, I'm not going to change my mind just because, just because they think it's a good idea. And so, I think if you are going to push back on a client's ideas, you have to have data to back it up, and you have to have a good argument. You can't just say, no, I don't like that idea, right? You because at the end of the day, it's their money. So you have to have a good argument in it, and you have to be able to, not even if you have the great data, you have to be able to present that data in a way that kind of makes sense. I mean, to be really honest, that's where the milkshake came from. I mean, I can't sit down with my clients and talk about the Basel III Accords, right? I can't ask them to read a policy paper that the Fed wrote in 1998 about inflation. So I have to come up with kind of normal everyday ways to kind of explain these kind of sophisticated concepts to them. And I think to the extent that you can do that, it'll make your job much easier. But then the other thing that I would say is I have actually, and this is not easy to do, especially if you're a younger person who's kind of building your business, is there's been times where I've just told clients, this just isn't going to work. I'm just, your philosophy and strategy is just very different than mine. And, it's nothing personal. It's just that's not the way I do it. That's not the way you want to do it. I just don't think it's a good fit. And so I think, what I would say is whenever you're managing somebody else's money and you're trying to convince them of something is, you kind of gotta have your philosophy. You have to be able to explain your philosophy, and then you have to stick to your guns. And, come hell or high water, that's what you got to do.
I also think you have to kind of attack some cognitive dissonance that happens during those periods, right? There was this hunt for yield for so long, and now that there's actual yield, nobody wants to hunt for it, right? And then people talk about making returns, and they forget that the biggest returns tend to happen after big drawdowns. Now, you can debate if the drawdown's over or not, but you have to kind of attack a little bit that psychologically, I think, and nudge the end client a certain way. But to your point, Brent, sometimes the best thing to do is just to fire a client that's not a good fit.
And again, you don't have to be rude about it. It doesn't have to be a mean thing. It's just, you can smile while you're doing it. Say, listen, guys, you can laugh and say, listen, this is not a good fit. You're not going to be happy. I'm not going to be happy. I can I can help you find somebody who maybe is a better fit. And, I can tell you your life will be better if you do that. Okay, so there's a number of areas I would love to invest in, but I don't want to do it now because, again, I think a global sovereign debt crisis is coming. And I don't expect, when a sovereign debt crisis hits, the last place I want to be is in an emerging market, right? I think on a relative basis, they are not going to outperform the US. But if that sovereign debt crisis hits and some of the assets or the prices in these emerging markets or frontier markets take a hit, then sure, I'd absolutely love to go in and buy them then. But I just think that what's coming down the pike is not good. And I think it's not good for emerging markets. And I know a lot of these emerging markets, sell commodities and have natural resources. And now with we're in this commodities boom, that's going to help them. And listen, I get it. I understand. I'm not discounting that, and it's very possible that I'm wrong. But I would rather buy them at a different price than they are right now. And I think I will get that opportunity if I'm patient. So the first answer on Japan, the reason that they haven't defaulted yet is because debt hasn't mattered yet. The Bank of Japan issues debt, and the government of Japan issues debt, and the Bank of Japan comes out and buys it all and puts it on their central bank balance sheet and keeps rates at zero or negative. And institutions go out and buy these negative yielding bonds and just hold them forever, which is absolutely insane. But that's what, again, debt hasn't mattered. Interest rates have not risen. Now, this is kind of goes back to the problem that we were talking about at the very beginning. Interest rates are starting to rise. And when you have trillions of dollars of, either zero yielding debt or negative yielding debt, when interest rates go up even 25 basis points, it's a huge problem. And that's why the Bank of Japan has had to come in and do yield curve control. Now, how do they keep from going bankrupt? They don't. They're either going to default or they're going to kill the currency, right? It's that simple. One of those two things is going to happen. They are not going to pay off all that debt. Now, what they could do, and I think probably will happen at some point, again, everybody thinks that the central bankers and these monetary are out of bullets and they've got no more power and the end game is here. And maybe they are, but these guys are really clever. I mean, these guys always figure out a way to kick the can down the road. And I think it's very possible that the Bank of Japan will just say, you know what, the debt that you have on our balance sheet, we're going to write it off. It's gone. And the government of Japan, you don't have to pay us for that. And, about 3 or 4 years ago, there was a panel at the Michael Milken Institute where they had a number of different strategists, and one of them talking about this issue. And one of them was the head of sovereign ratings for Fitch. And he was asked, if the Bank of Japan were to forgive the debt that they owe of the government of Japan, would you raise your credit rating or would you drop your credit rating on Japan? And the head of sovereign ratings for Fitch said, I'd probably raise their credit rating. So, who knows what happens? But my point is they can't raise rates, and they cannot ever pay the debt off. So they're going to have to be some, shenanigans go on to kind of keep the game going, or else we're just going to have this sovereign debt crisis that I'm talking about. And it's kind of the same issue with the United States. Like we're in a bad spot. It's not going to end well. I just think that the U.S. is going to last longer than everybody else, and so I think we will be able to fund our treasury, or through a combination of self-funding. Maybe the Fed helps out. Maybe foreigners help out. Will fund our treasury longer than they will fund ECB treasury, longer than they will fund Bank of Japan treasury, Australia treasury, Canadian treasury. I think we will be the last man standing, regardless of where rates are at. I wish there was a way to kind of educate the world on the whole euro dollar market, because the fact is it's this big spider web that nobody even really understands. And I'm not going to sit here and pretend that I understand it fully, because I don't. But I've spent so much time trying to understand it that I'm relatively certain I understand it better than most people. And so when I hear these ideas that there is no dollar shortage, or it's no problem to provide dollars to the world, well, take a look at the euro dollar market and then come back to me and let me know, because what you're touching on here, and maybe this is a good place to end, is that you've seen these various graphs that show what percent of the bond market does the Fed own, what percent of the market does the Bank of Japan own. And while we own a lot of it, we own relatively less than the rest of the world on their balance sheets. But not only that, when you think about how the bonds and the amount of stimulus that we did, and they'll compare it to like M2 or something. Well, the problem is they're comparing domestic M2s to all these other central bank balance sheets. But the reality is that for the US M2, that's a fraction of the overall global dollar market. So when you consider the size of the overall dollar market and euro dollar market in particular, the amount that the Fed has put on its balance sheet is tiny compared to what the rest of the world has done. And, if and when we go into a situation where global growth slows, credit is not being extended, there's going to be a huge, huge dollar shortage. And I think we're just getting started on that.
All I heard for the last 45 seconds was few understand this. I just want to put it out there. That's what I heard.
Fair enough. Good point.
So everybody here that's joined, I certainly appreciate everybody spending the hour. Please make sure you follow Brent. I'm actually going to be doing another space at 5 Eastern with Gareth Soloway. Again, I'm trying to play catch up on some of these recordings for the YouTube channel. Brent, as always, I really do appreciate the time. I think this was very timely. And everybody, please enjoy the rest of your day. So I'm not going to see you at 5. Thank you, Brent. Appreciate it.
Thanks, guys.